Investors I'm speaking to see the lending environment and its impact on both securing new loans and refinancing assets as major trends to watch over in the next few months. One of the challenges that comes to mind is the cost and availability of debt. Is it affordable to get a high floating rate? And is it worth riding it out till the debt market comes down? This is naturally leading into less buyers in the marketplace, which has also caused CAs to be down a good amount. As far as rates going down, currently Wall Street expects interest rates to stay relatively stable for the near future and also doesn't expect significant downturn movement to interest rates until at least 2024, meaning the market will adjust to a higher interest rate environment before we see rate cuts. But this doesn't mean there aren't opportunities. Hoteliers are inquiring about distressed and foreclosed assets. As loans are maturing, there is anticipation of assets coming up. No one has an exact timeline, but being patient for now and being aggressive when deals do surface is the mindset of many hoteliers, especially in downtowns of certain major markets. Also, there are assets sitting on the market from some of the top brands. Sellers that are motivated may sell 15 to 20% pricing valuations of 2021 and 2022 in certain situations. As hotel companies continue to launch new brands, some of which are conversion brands, this gives hoteliers the chance to buy assets and convert them to one of the higher brands which did not exist before. This also gives an opportunity for some of the older boxes to have new life. But the demand drivers for hotel rooms are trending positive, with consumer confidence remaining steady and airfares in certain parts of the country easing compared to last year. Leisure travel has already returned to levels above 2019, and business and group travel has finally begun to narrow the gap. All of this contributes to a sharp ADR recorded over the last year or so, resulting in RevPAR surpassing their pre-pandemic level in most metros and product types. RevPAR is up significantly from pre-pandemic levels in many secondary and tertiary cities, as well as many suburban locations. That said, we have recently begun to see occupancy flatten and ADR increases are moderate. So, this disconnect between solid demand and growth prospects and uncertain financing conditions is creating a sizable gap between the expectation of buyers and sellers. What does this mean for buyers? Once again, they need to be patient and be very selective in their deals. Look for motivated sellers to capitalize on good opportunities and take advantage of minimal institutional competition for listed properties. Value-add deals for cash purchases can also be an option for investors looking to capitalize on uncertainty or reposition their portfolio. As for sellers, I see a few options. If they are not getting the price wanted, they can wait for the cost of capital to decline, which will hopefully increase the buyer pool and drive pricing than what is available today. Or they can sell now if they have a capital call coming up, or reposition into an asset they like more moving forward. However, even with the reduction in pricing, sellers can still take an advantage of the post-COVID boom relative to their buy-in price. In my opinion, over the next 2-3 quarters, there will still be a number of trends taking place. Transaction volume will still likely stay below 21 and 2022 until the debt market stabilizes or the buyer-seller expectation gap narrows. However, there will still be some sellers that cannot hold on any longer due to debt coming due, and there will be deals occurring that make sense for the buyer and seller. Commercial real estate is a resilient industry, and agents and investors need to stay on top of the economic conditions and trends. But the outlook is positive over the long run for hotel investments.